Is it sea change time for the Bank of Japan? Or is what's going on with their inflation just a sugar high and the central bank can keep sitting on the longest easing cycle of the major economies for another decade or so? Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. Welcome to the show. And today we are going to put our forensic economics hat on and find out what in the world is happening in Japan and why is it different from everything else that's going on in the global financial markets. Everybody of them is fighting inflation. All the major central banks. We just heard from the Fed this week. We heard from the ECB this week, and of course now we're going to hear from the BOJ. And the market smells something like a major change. We've, of course, been flirting with this idea for a while. That was an explosive decision to alter the Bank of Japan's yields cap earlier in the year that sent wild shockwaves through financial markets, because here is a central bank that hasn't done anything meaningful but ease policy more for the better part of 3-4 decades. But something different might finally be afoot. Let's find out what that is, if it is there, and whether it actually matters, because, of course, if there is another tidal wave of repricing, we should probably be ready for it. So let's consider what is going on here. This is the structural story, just to get us acquainted here with the situation. This is going back all the way to 1973, folks. And what you see is a structural decline in Japanese interest rates. And of course, right alongside that, and indeed the reason for it, a structural slide lower in inflation. You can see Japanese inflation has been going down and down and down for decades. It has been idling here since about the late 90s, early aughts, just around the zero mark. And not even incredible scale of stimulus has been able to change this dynamic. You can see in the yellow there is the Bank of Japan's balance sheet. So this is just QE. Consider what QE we have in the U.S. And the conversation around how inflationary that could have been. It, of course, wasn't in its 08, 09 and subsequent version until fiscal policy joined the party after COVID. And this is a wonderful example of that first version, where the Bank of Japan is piling money onto the economy. We have it here as a percent of GDP. So you can see the Bank of Japan now owes more than 100% of the size of the total economy in Japanese assets. So it owns more government debt than is the entire size of Japanese GDP. And it still can't get inflation moving higher in a structural sense. Why is that? Well, take a look here. This is that same rates story. This is that same inflation story. And the yellow or the orange line that you're seeing here, that's the growth rate in Japanese working age population. We talk a lot about the aging of the population in Europe. We talk a lot about the same in China as being a threat to economic growth and vigor. Needless to say, Japan was out in front on this long before them. You can see that the growth rate in the working age population has been slowing for decades and has actually dipped negative now. So we are actually seeing a reduction demographically in Japan's labor force at this point. We are actually below replacement now. And what this speaks to, of course, is an aging that's been going on for quite a long time. Now, when consumers are relatively younger, when they're early in their economic life, They are in a phase where they do a lot more consuming. They are perhaps buying their first home, perhaps starting a family, perhaps starting to put children through an education, starting to accumulate assets where they didn't own them before. And so it's a very consumption-heavy phase of life. Well, as the population ages, more and more of the population is not in that phase. And as we know, we have a situation in most of the world's advanced economies where consumption is by far the biggest driver of GDP growth. We're usually talking about something on the order of 70%, give or take. And what's been happening in Japan for decades now is more and more of the population is out of the heavy accumulation phase, out of the heavy consumption phase, and into the spending and holding what's there phase. And so what we've seen is this structural change in who the consumers are. And what that's done is it's anchored economic growth. It's kept things very much anemic, other than periods episodically where you get a particular swell in external demand. But of course, even that's fading because the number of people available to work to capture those things is diminishing. And so Japan is increasingly doing things like near-shoring production centers near their main consumers. This is, of course, the case in spades for auto manufacturing for the critical U.S. market. A lot of those factories are not in Japan. They're much closer to the U.S. market itself and oftentimes in the U.S. So what you're seeing here is a structural decline in demand pull inflation over decades and decades and decades because of this demographic shift, because there is just not the kind of consumption vigor to really get this off the ground and inject some pricing power into the equation. If you look at the way that this has worked out in this current episode, you can see that a lot of Japan's inflation does indeed appear to be imported. So the yellow bars that you see there, that's Japanese CPI, there with an 8-month lag behind the Bloomberg Commodity Index. You can see that as we've had this swell in commodities demand with reopening from COVID and an absolute avalanche of stimulus from the major economies, we said that inflation needed fiscal authorities at the top of the show to be doing their bit to really get off the ground. And of course, here is a case in point. The reason that monetary policy can't necessarily just create inflation out of the thin air is, of course, because what monetary policy can do is encourage borrowing by making it cheap. What it can't do is get people to borrow. It can only create the conditions for it. And then if they do borrow, can't necessarily get them to spend. And if you do get them to spend, you can't necessarily get them to spend on the things you want them to spend on. And so a lot of the capital from the massive amounts of QE that, for example, the U.S. did in the wake of 09's crisis went into asset markets as opposed to the economy. And so your consumer price inflation levels never really got off the ground. But of course, the stock market took off. Looking at what's going on in the situation in Japan, we can see that what we have is that kind of a thing this go round has been put on steroids because fiscal authorities actually spend money. They actually create demand. It's not encouragement, it's actual buying of things. And so what fiscal authorities did here in dumping tremendous amounts of stimulus on economies during the COVID process and then reopening from lockdowns to enable the spending of all of that money has been an upswell in commodity prices, which, thanks to central banks' efforts to cool demand, is now coming off. Not surprisingly, the peak that you see there is early 2022, just as the Fed starts to really tighten monetary policy. So you see commodities begin to come down. Japanese inflation lags that by about 8 months. Not surprising, of course. Markets are forward-looking, and it takes time for things to filter through. So if you look at the lead there, you can see just as there was a bottom in commodity levels, so too there was a bottom in Japanese inflation. As this has gone up, so too this has gone up. And as there has been disinflationary pressure from commodities, so too Japanese CPI has started to come off. Very tellingly, you can see the pressure is not domestic because you can see wages are actually lagging with CPI by about 7 to 8 months. So it's not a situation where what you have is economic vigor that's putting pressure on the labor market. Employers start to compete for scarce workers, especially in Japan, where we know we have this demographic situation afoot now. And that's giving us inflation because of rising labor costs entering into the price of all things. This is the other thing, where the global price of stuff is going up. Japan is an island, so of course it imports everything. It's deeply sensitive to the global cost of commodities. Those commodities go up. They increase the cost of living. Folks go to their employers and go, I can't afford my usual expenses. Wages need to go up. Wages here are following CPI, following commodity markets, not leading. So this very much looks like imported inflation. Doesn't look like the kind of thing that the Bank of Japan needs to do anything about, as long as the Fed continues to raise rates, or at least as long as tightening from what they've already done continues to filter in, which will be months and months yet, even if the Fed does nothing else at all. So what's the source of concern? Well, if we look at where inflation expectations in Japan are going, they're pointedly going the wrong way. The market is clearly not convinced that this is just a transitory, going to filter out by itself kind of thing, seemingly. That's the 5-year break-even rate there. It measures the bond market's baked-in inflation expectation. That's just the difference between nominal and real bond yields. When you take that difference, you end up as residual with the inflation adjustment that got you from nominal to real. And so that tells you what the bond market thinks inflation is going to do over the relevant period of time here. And so that's the 5-year, so about medium term or so. And you can see that it was rising with overall CPI, again, 8-month lag there. It's moving in real time, much as the commodity index does. And it's going the wrong way. CPI has come off, but the lead from this break-even rate would suggest the market doesn't think that this disinflation is going to continue. It thinks inflation is going to be higher. Well, if it's already going down, as we saw here, because commodity costs are in remission, then why does the market think this? Let's unpack it. Here are the components of Japanese inflation. Now, this is a complicated chart a little bit, so let's take this in slowly. What you see in the thick red line there is the actual path of Japanese inflation. And in the colored mapping behind it, what you see are the share contributions. And what you see is energy is, of course, at this stage in the process, a disinflationary force. We've talked at length here about energy prices declining. Much of that have been essentially owing to the rapid decline in crude oil, rapid decline in natural gas, a much faster decline in those things than in overall commodities. And that, of course, makes sense because Russia appears to be flooding the market. We've talked about this at length before, this notion that Russia can only export so many things given their current sanctions regime, one of which is energy. And they would very much like not to lose market share while they're locked down, and this is their only source of income because, of course, they have a war to finance. So we are in a situation where they are aggressively trying to undercut other exporters because they don't want to lose the one area of income they still have. One of the last ones. Grain exports represent another. So energy is understandably now a disinflationary force. We get a little bit of a influence here from housing, a little bit of an influence from the goods sector, a little bit of an influence from services, but you can see the issue is not really domestic demand. If this is domestic demand right here, it is not a very big component of this. The really big piece is food. Food inflation appears to be the reason why inflation expectations are going the wrong way in Japan. So why is that? Well, consider here, that's that 5-year break even, alongside the Bloomberg commodity subindex that tracks just soft commodities. So these are usually agricultural type commodities that would go into benchmarking food prices. And of course, as we said before, Japan is an importer of a tremendous amount of the overall consumption basket because it is an island. So what we're looking at here is the one pocket of the global commodities pie. We've just looked at the overall commodities index. We can see it's falling. This is one of the few areas where there is actually something relatively positive for commodities at this stage. If we look at all of the big sort of areas of the commodity markets, energy, industrial metals, even agriculture as a bigger category, it's down. Agriculture is down because, as we just mentioned, grain prices are collapsing, and it's because Russia is flooding the market. But for soft commodities, we actually have an upswing. And it's an interesting one. This is one of those little macro stories around the markets that don't neatly fit into the big, larger narrative. The key that is uplifting soft commodities here is, of all things, sugar. So that softs index is very much skewed to the price of coffee, the price of sugar, and sort of similar type of things. Sugar is the one place here where you're actually seeing strong gains. And not surprisingly, this is coming from a relatively small story, a relatively localized story. India is the third largest exporter of sugar, accounting for about 6.5% of the market. The largest is Brazil, with about a 28% share of the market, then Thailand at 11, then India at 6.5, and it really starts to come undone from there. Australia is 3.25. Guatemala is less than 2. So India is a very important component of this market, and they've decided to stop exporting sugar, essentially. They've introduced tremendous sugar export caps because they're afraid that El Nino is going to decimate the crop and that there's going to be shortages domestically, and they simply can't abide that. So they've put caps in in place at least until next year. And the message out of the administration is they're going to be in no hurry to lift those. So there is a legitimate old school shortage of sugar on the market. And that seems to be driving up food costs. Not just in Japan, certainly, but Japan is feeling them in an outsized way. And that appears to be why inflation expectations are going up, and why those inflations going up, those inflation expectations going up don't seem to jive with what's going on elsewhere. It appears to be a one-off kind of story, a literal sugar high. And so if we look at some of the other factors in play here to search for domestic demand, it's easy to find conflicting narratives. Here's the PMI composite here, and you can see the catch-all measure is trending higher since late last year. The service sector measure is trending higher. Even manufacturing has found a degree of growth. PMIs, of course, operate on a system based around the 50 level, where above 50 is growth, under 50 is contraction. The further you go in each direction, the faster you are moving. So the further you go above 50, the faster the growth. The further you go under it, the faster the contraction. Most global manufacturing for most major economies is in contraction. In Japan, it's actually seemingly a little bit positive in May's data. So one could look at this and say, well, there's something for the Bank of Japan to do. This inflation is perhaps not just a transitory thing. But then, of course, you look at the economic surprise index and you see that the overall flow of economic data in Japan has actually been going in the wrong direction. So perhaps these PMI numbers are masking something that isn't quite as robust as it seems. Because although these things are in fact up, the overall picture for incoming economic data is soft, or at least softening relative to baseline expectations. And you can see how that's reflected in monetary policy bets. This yield curve, measuring the expected path for Japanese rates, you can see it is at this point absolutely steady. You're looking at maybe the possibility of some rate hikes going out 2 years or so, but until then, stasis. Much more importantly, it hasn't moved but a little bit since the last BOJ meeting in late April, and at that, it's actually moved lower. It's a little bit higher relative to a week ago, where it looked even more dovish, but no major changes here either way. So the market is looking at the sum total of these growth indications and saying, this is not anything for the Bank of Japan to actually act on, or at least the markets aren't expecting that there will be action. And indeed, looking at the expectations here for policy, we can see a mere 11% chance of a hike at this meeting. There is some flirtation with the possibility that you could come off the negative bound on rates, perhaps by the end of the year. But as you can see, all these numbers are absolutely tiny. So at no point here do you get to a convincing rate hike. Come October, December, you start to see the probabilities of a hike get a little bit north of even, which of course makes sense in an environment where inflation expectations are rising. But this is not a market that is by any means convinced that the Bank of Japan is going to do anything near term, and that in fact it is just the sugar high that these inflation expectations are talking about. Now, there is one more thing to check off our list here. because, of course, as we just mentioned at the top of the show, there was an explosive change in Bank of Japan yield curve control policy earlier in the year that sent dramatic shockwaves across the global financial markets. Is it possible that we could get not a rate hike, but another yield curve control adjustment? It could be. Well, let's consider. So, we've discussed many times here on Macro Money that when the Federal Reserve raises interest rates, it raises borrowing costs not just in the U.S., but everywhere, save for the handful of economies that are completely disconnected from the global commercial system, like, say, North Korea. And that's because most global commerce is done in dollars. 88% of global monetary transactions, give or take, according to the Bank of International Settlements, are ultimately settled in dollars. So when the Fed increases the cost of borrowing dollars, it's increasing the cost of borrowing the quintessential medium of commercial exchange, powering almost all economic activity almost everywhere. Now, that's all well and good, but Japan has been saying we're going to have a target of 0% on our 10-year yield, and we're going to defend that level, and we're going to allow a threshold of plus or minus, going into the volatility here, 25 basis points. That's the wiggle room we're going to give it, around 0, before we intervene. So what you see here is the Fed starts raising rates. That starts to drive up yields. That's the green bars that you see in the back here. That's the U.S. 10-year yield, just to keep our tanners aligned here. And what you see then is that starts to pull the 10-year Japanese OIS inflation swap higher, or OIS swap, rather. What that's telling you, basically, in a nutshell, is the market thinks the 10-year yield in Japan should be going up too, as it is going up everywhere, because what the Fed is doing is increasing borrowing costs writ large. That's this right here. You can see there begins to be a divergence as you get into the beginning of last year, where the Fed really starts to raise rates. This, then, is what the Bank of Japan would be seeing if it weren't intervening. This is what the market is saying should be going on. You can see that before the Fed starts raising rates, the actual JGB yield and this swap are almost perfectly in line. And then right as the Fed starts to really tighten, they split. The swap surges in sympathy with what the Fed is doing, but the Bank of Japan is keeping a lid here at the 25 basis point threshold until it becomes untenable. The market is pressuring things way too hard, and so this is the readjustment. The Bank of Japan says, okay, we'll allow up to 50 basis points in leeway, and so there's an immediate surge. And this, of course, spooked not just Japanese markets, but everybody the world over. However, the pressure for something similar again seems to have come off. As you can see, U.S. yields appear to be broadly flatlining here so far in the first half of this year, at least in terms of the overall direction. They seem to have stopped consistently pushing higher as they were before. And you can see the swap in Japan has come off. And so the pressure on this yield curve cap that the Bank of Japan is instituting, that's come off too. So there's not a pressure seemingly to adjust that part of the policy either. Not rates, not yield curve control. And so one might ask, well, what then is still the main story in Japan? What's driving these markets? And you can see it here in the Japanese yen. In the red there is the 6J future. In the dark blue there is an average of global interest rates, US, Eurozone, UK. So the majors here defining global borrowing costs. And as ever, you can see the impetus for this still is the direction of global rates rather than anything going on in Japan. So clearly here, the takeaway seems to be if global rates go up, that's yen negative. If global rates go down, that's yen positive. Because, of course, actually seeing any kind of rate hikes or any kind of meaningful tightening from the Bank of Japan still looks distant. And so if rates are going up elsewhere, that increases appetite for what is called the carry trade strategy, which is borrowing cheaply in yen to buy things that yield more. And so that's exactly what this represents. With the rising opportunity to buy higher yielding things outside of Japan, capital flows from Japan out of the currency and overseas. And of course, vice versa, when yields are coming down. As for Japanese inflation actually triggering some kind of a sea change, well, apparently not so much. Apparently, sugar is what is the culprit here, and there's not a whole lot that the Bank of Japan can do about that. And that is macro money for today. This was the last episode for this week. We are off on Monday for the Juneteenth holiday, but we're going to be here for first call that day. I'll be joined by Chris Vecchio, head of Futures and Forex, here at Tasty Live for that. We're back with macro money on Tuesday, and we are usually, as ever, here Monday through Thursday, right after overtime, where Chris and I break down the day's events in markets and try to make sense of them. I'm also on that first call, usually on Sundays, with Tom and Tony. Outside of those shows, I am opining on Twitter at Ilyas Pivak. Thank you very much for joining, everybody. Good luck trading out there. See you next week.